to discuss China's economy and stock market. We're now joined by Dan McClory. He's Managing Director at Burnham Securities. Dan, good to see you. Thanks for joining us.
Thanks, Michelle. It's great to be here.
Dan, let's start off with the recent data. China's official manufacturing PMI standing at about 50.2 in June. That was unchanged from the previous month. Keeping in mind anything above the 50 mark shows growth. Dan, do you agree that we're seeing some leveling out here?
We absolutely are, but as you indicated and as Li Wan told us from Shanghai, this wasn't completely unexpected. What we did see was a rise in services, and the services sector I find to be encouraging because, as we both know, China is rebalancing its economy from a low-cost manufacturing-led economy, which is slowing, to eventually offshoring that activity. And value-added services is where China wants to be, so we're pleased to see growth in that segment.
All right, Dan, so this is all in line with the rebalancing intentions. As you mentioned, we had some growth in the resource sector. Let's talk a little bit about the mixed data that we've been seeing. Higher unemployment in the manufacturing sector, but service sector was up. Property prices and sales have also shown some signs of improving in recent months, at least in the big cities. So you think this is not a concern? The economic data is all in line with the rebalancing of the economy?
Well, I would again say it's not totally unexpected. As we talk to global investors, they're primarily interested in four key segments of the Chinese economy. That would be precision manufacturing, so high-value manufacturing, financial services, which is definitely on the upswing, consumer, and also energy and alternative energy. There are lots of opportunities in those sectors, and that's where I think we're going to see some growth in the coming quarters.
All right, so given this, speaking of growth, the government is due to release the second quarter GDP numbers on July 15th. Many economists expect growth to dip below that 7%. Now, that would be the weakest performance since the global financial crisis, if that does happen. Dan, what are your expectations for second quarter GDP?
I think providing we still have a stimulus with the financial services industry, that is in the stock exchange, that we're going to see some continued growth. Again, there's a correction that's going on here. You know, when you talk about 7% growth, as you're aware, Michelle, you know, every nation on the planet except for China would die to have that kind of a growth rate. So we need to keep those numbers in perspective. And we also need to think about what China is doing from an outbound perspective. You know, China is going to become the world's largest holder of foreign assets by the year 2020. By some estimates, around $20 trillion. This is an area that's going to bring additional economic activity to China. China outbound is an area that we look at, where Chinese companies are acquiring assets, distribution channels, manufacturing brands outside of China, which is ultimately going to lead to a continued resurgence and growth of the Chinese economy.
Right, and as you say, Dan, 7% GDP. Definitely the envy of most economies around the world. Let's talk a little bit about what's happening with the markets. And the People's Bank of China did announce some aggressive monetary easing over the weekend. They cut both the interest rates and the reserve requirement ratio for select banks. But the markets seem to shrug it off. Why is this? Is this just expected now that we're going to get more stimulus from Beijing?
I think everyone knows that the last thing Beijing wants is to have instability. And so although it was a historically low rate cut, it wasn't completely unexpected. And in fact, we saw a bounce. It took until Tuesday when that news came out on Saturday. We saw a bounce on Tuesday, but as we pointed out, those gains were wiped out in today's correction. So I think you're going to see a combination of factors, as we've talked about the reduction of the stamp tax that goes into the acquisition of stocks, the ability of Chinese government pensions to purchase equities. You've also talked about the bank reserve requirements, those being reduced. So I think it's going to be a combination of factors that Beijing is trying to put in place for, if there is one, a soft landing to a correction of some of the volatility in the capital markets.
Well, it seems like the soft landing has pretty much happened, most would say. But what is also very clear is that we're seeing so much volatility. The Shanghai Composite down over 13% just in the last 5 days. Prior to that, it was up 60% year to date, more or less. So, Dan, what is driving all this turbulence?
Well, let's remember that Shanghai has doubled year over year, and Shenzhen and Chinex still up 65% on the year as the world's best performing exchange. But most experts agree that the turbulence is being driven by short swing selling, which is being brought on by particularly active retail investors who are trading in companies which have relatively small floats that are out in the market. And as a result, those small floats are being traded at enormous rates of velocity. And some of this is being fueled, Michelle, by margin lending. And margin lending right now is about $350 billion. That's the formal margin lending market. Analysts would say that there's an informal margin lending market which is equal to or greater than that amount. So when you have these swings and these losses, there in fact could be margin calls, and that's drawing liquidity out of the system as well.
All right, Dan, unfortunately, we are out of time. We're going to have to leave it there. Thank you so much. Dan McClory, Managing Director with Burnham Securities. All right.